Capital market. Capital market may be defined as a market dealing in medium and long-term funds. It is an institutional arrangement for borrowing medium and long-term funds and which provides facilities for marketing and trading of securities. So it constitutes all long-term borrowings from banks and financial institutions, borrowings from foreign markets and raising of capital by issue various securities such as shares, debentures, bonds, etc. In the present chapter, let us discuss about the market for trading of securities. The market where securities are traded known as securities market. It consists of two different segments, namely primary and secondary market. The primary market deals with new or fresh issue of securities and is, therefore, also known as new issue market, whereas the secondary market provides a place for purchase and sale of existing securities and is often termed as stock market or stock exchange. Primary market. The primary market consists of arrangements which facilitate the procurement of long-term funds by companies by making fresh issue of shares and debentures. You know that companies make fresh issue of shares and/or debentures at their formation stage and, if necessary, subsequently for the expansion of business. It is usually done through private placement to friends, relatives and financial institutions or by making public issue. In any case, the companies have to follow a well-established legal procedure and involve a number of intermediaries such as underwriters, brokers, etc., who form an integral part of the primary market. You must have learnt about many initial public offers, IPOs, made recently by a number of public sector undertakings such as ONGC, GAIL, NTPC and the private sector companies like Tata Consultancy Services, TCS, Biocon, Jet Airways and so on. Secondary market. The secondary market known as stock market or stock exchange plays an equally important role in mobilizing long-term funds by providing the necessary liquidity to holdings in shares and debentures. It provides a place where these securities can be encashed without any difficulty and delay. It is an organized market where shares and debentures are traded regularly with high degree of transparency and security. In fact, an active secondary market facilitates the growth of primary market as the investors in the primary market are assured of a continuous market for liquidity of their holdings. The major players in the primary market are merchant bankers, mutual funds, financial institutions, and the individual investors. And in the secondary market you have all these and the stockbrokers who are members of the stock exchange who facilitate the trading. Characteristics of a stock exchange are: A. It is an organized market. B. It provides a place where existing and approved securities can be bought and sold easily. C. In a stock exchange, transactions take place between its members or their authorized agents. D. Transactions are regulated by rules and by laws of the concerned stock exchange. A. It makes complete information available to public in regard to prices and volume of transactions taking place every day. Functions of a stock exchange. A. Provides ready and continuous market. B. Provides information about prices and sales. C. Provides safety to dealings and investment. D. Helps in mobilization of savings and capital formation. A. Barometer of economic and business conditions. F. Better allocation of funds. Capital markets instruments. Equities. Equity securities refer to the part of ownership that is held by shareholders in a company. In simple words, it refers to an investment in the company's equity stock for becoming a shareholder of the organization. Also, the equity holders get ownership rights and they become one of the owners of the company. Bonds. Bonds are fixed income instruments that are primarily issued by the center and state governments, municipalities, and even companies for financing infrastructural development or other types of projects. It can be referred to as a loaning capital market instrument, where the issuer of the bond is known as the borrower. Bonds generally carry a fixed lock-in period. Thus, the bond issuers have to repay the principal amount on the maturity date to the bondholders. Debentures. Debentures are unsecured investment options unlike bonds and they are not backed by any collateral. The lending is based on mutual trust and, herein, investors act as potential creditors of an issuing institution or company. Derivatives. Derivative instruments are capital market financial instruments whose values are determined from the underlying assets, such as currency, bonds, stocks, and stock indexes. Exchange-traded funds. Exchange-traded funds are a pool of the financial resources of many investors which are used to buy different capital market instruments such as shares, debt securities such as bonds and derivatives. ETFs having features of both shares as well as mutual funds are generally traded in the stock market in the form of shares produced through blocks. ETF funds are listed on stock exchanges and can be bought and sold as per requirement during the equity trading time. Financial markets are a very important part of any country's economic structure. The well-developed and smoothly operated financial market plays a major important role in the growth and efficiency of a country. It helps in the efficient direct flow of savings and investments in the economy, which facilitates the accumulation of capital and contribution in the production of goods and services. The blend of well-developed financial market and the diverse range of financial products and instruments best suits the demand for borrowers and lenders as well as the whole economy. The financial market provides corporate, industrialists and the governmental entities access to capital. The prospect of a financial market is to set prices for global trade, raise capital, and transfer liquidity and risk. In next video we will discuss types of financial products.